So joining me is Emma Smith, who's the founder of Sandpiper Communications. She is, like me, based in Asia. I'm in Singapore, and she's everywhere really, but Hong Kong is home. It's a specialist corporate communications and public affairs agency. Interestingly, she had sold her agency in 2019 to Engine, but chose to buy it back some 4 years later. So feel free to ask her questions around that. But in the 4 years since that management buyout, she has grown her firm with her team quite exponentially. Geoff Allan is San Francisco based, but his fund, which is Partners for Growth, provides debt right across the world, Latin America, Asia. We've tapped the fund in Asia and Australia, and right across the world. It's focused on providing growth capital to companies in the tech and growth stages. So let's start with a question to you. When you think of debt providers, raise your hand if your instinctive reaction is that they're loan sharks or vultures. Yeah.
I've got my hand up.
Yeah. Actually, that's interesting. In Asia, it would be 95%, actually. So you're in a good audience. And instinctively then, do you see VC and private equity as white knights? Raise your hand if you see them as white knights. Okay, interesting. The complete opposite to Asia, where Asia and Australians see PE and VC as white knights. Interestingly, on the M&A side, I should say that the same principles that Davis Gilbert's research threw out in terms of what was the trends in M&A are exactly the same. So it's interesting that unlike M&A, that this audience is completely the opposite. So I thought you'd be on the defensive, Geoff, but clearly this is a receptive audience.
Yeah,
what do you look for what's your experience been of engaging with professional services firms like marketing services and public affairs?
Yep. Yeah, good question. And happy to join. Thanks for having me. I think one of the aspects with professional services firms, at my fund, PFG, we focus on technology and growth businesses, very broadly defined, and that includes tech-enabled companies such as more service-oriented businesses, like a PR firm or a consulting firm. But a lot of times, the founders are still involved in the business, and it's very much driven by, a few key kind of rainmakers, the initial management team, typically very closely held as well in terms of ownership. So there's, they might be also structured a little bit differently than a more traditional technology business. So it could be, say, an LLC structure, things like that. So it has a little bit of particulars to be managed. But overall, though, even if we're looking for working with a service business, we're looking to many of the same things that I think any debt provider is looking for. They're looking at, is there a growth story in the business? If the company is not yet profitable, what does the path to getting to break even look like? What are the characteristics of the business that can get a debt provider, or frankly an equity provider, interested in terms of how sticky are your relationships with your customers, how repeatable the business is, has the company or the founders, have they been able to develop a culture and an organization that is bigger than the few folks at the top? If they decide to retire or walk out the door, is that the end of the company, or is there something that's more structurally, it has some legs to it? Those are some of the factors that we look at.
And do funds like yours like to deploy capital alongside, for example, private equity, helping founders reduce dilution, for example?
Yeah, absolutely. I could speak to my own fund, but to many others that are out there that provide debt. It's at its core, it's just another solution that you can think about, another capital solution for how you want to build your business. So very high level, you can think about, you can either finance your business with your profits and keep reinvesting those back in if you're operating profitably, or if you're looking for outside capital, you can sell this much of your business if you're raising equity, or you could consider bringing on, a similar chunk of debt, and maybe you're giving up, that much equity. So you could save substantial dilution, or maybe you're bringing on debt that has no equity component at all. And many providers, they will either come in alongside equity, so you could save a little bit of dilution there, or they might come in lieu of it as well. So kind of everything's on the table.
And interest payments, we know, are tax deductible across the world, and M&A models typically are driven by EBITDA, although there's a plethora of valuation models now. Right across the world, there's interesting tax-driven structures which help to reduce interest costs. In the case of the US, business development companies, for example, in the UK, VCT and EIS, and for both Hong Kong and Singapore, government-driven loan schemes. Have you seen business development companies deploying capital in professional services firms, or mainly in asset-heavy industries?
A little bit. In terms of BDCs, providing capital to professional services firms. I mean, again, I think a lot of the BDCs out there, they're fairly large, so they're looking at substantially sized opportunities to put their capital to work. I guess I would say high level, I think a lot of debt providers, they're really looking at the business itself and looking to what are you going to do with this capital? How is that useful to the company, as opposed to kind of some incremental tax strategy, or that's probably, maybe once you're in the hundreds of millions of revenue or something. But with many of the companies, at least that I work with, they're typically anywhere from kind of 5 to 10 million in revenue on the low end up to kind of 100. And so really specific tax stuff is maybe less of a concern compared to kind of the overall benefit of the capital to basically grow the business.
So Emma, why haven't you tapped debt? You've grown your offices from 3 to I think 7, and soon I think to be 8. You've chosen to use your dividends. Yeah. Why is that?
Well, I guess probably the number one reason would have been to keep as much of our independence as we possibly could. We like to take chances, calculated chances, but we do like to do that. And I thought it would be probably easier for us to do if we were completely independent. But also in Asia, this is quite a new concept, I feel. I only know 1 or 2 firms that have actually done that and taken debt. Yes, there's been private equity investment, but most of the time it's either taking that or it's just reinvesting your dividends. So we've just reinvested our profits over time. So we grew our revenue 4 times in 3 years by doing that, by mainly putting different people into different offices, starting new practices, going into new geographies, and that's the way that we have expanded our business. I guess the question I would have, am I allowed to ask a question?
Yes, absolutely. To the audience or to...
No, to Geoff. I want to ask a question to Geoff. I guess I'd like to ask you, Geoff, what type of guarantees would you want? Because as an owner of a business, really all we have are our accounts receivables. We don't have much else, do we? We have the amount of money that's coming in and we have our profits. We don't have collateral. We don't often have real estate. So what type of guarantees would you be looking for from a company like mine?
Yep, good question, Emma. I think the first thing to think about is the debt provider that you're talking to. Are they going to be secured on assets or on the company, or unsecured? So that's a key consideration. In terms of specific guarantees, we certainly never ask for personal guarantees. I think most, at least US funds, would not do that. But there's some groups out there, especially internationally, that do. So that's something to understand. I would be extremely careful with that. of course. In terms of the business, I mean, the way that we think about it, you can kind of lend against cash flow if the business is profitable. You can lend against assets, accounts receivable, or hard equipment, but most of the companies, at least in the technology or service space, are very asset light. Or you can lend against the enterprise value. And so at least at PFG, a lot of what we're doing is looking to characteristics of the business that are not necessarily traditional credit metrics, things that a bank can't get comfortable with, but that nevertheless, and might not show up on a balance sheet, but nevertheless can get a capital provider comfortable that the debt can eventually be repaid. And obviously that's, I mean, it's not a 100% replacement for equity in all cases. Equity is permanent capital, or even in your case, you haven't even had to do that. You can use your own profits to grow the business. But the key thing, since debt does have to be paid back eventually, that's the fine print. Those are kind of what we're looking to. But a lot of it is enterprise value. So we're looking to provide more capital than a company could access based on just their accounts receivable.
And for me, I think the key issue is there is diversity of requirements. That's true. The great thing about private credit funds is they're not Basel III requirement to be compliant, which in layman's terms or layperson's terms is that they don't follow the same rules as banks. They're more flexible in terms of both interest repayment and Julian referenced earlier in his notes about how interest costs have gone up. What's most important, I think, when you look at debt is how the repayment is done. What is the profile of the debt? Because if it is true that a provider of capital can see where the end result is the founder going to sell? Are they going to grow faster by harnessing non-dilutive capital? Then they might back end the repayment. So it's important to do that cash management profile. But just picking up one of the themes of your questions, one of the reasons why it feels you haven't used debt is your feeling of losing control. What's interesting is that debt funds do not get a board seat. They might get a right to receive certain information, but in essence, they don't have a say in your day-by-day operations, unlike potentially PE. One of the fears that we hear in Asia, where this comes up, and in Europe also, is what happens if things go wrong. And I wanted to touch on with Geoff the importance of regular communication, not waiting until something goes wrong. How do you engage with your issuers as things happen? And good things and bad things can happen.
Yeah, and we just echo. I mean, that's exactly right. As a debt fund, I mean, we don't take board seats. We are not there to sort of tell management or founders how to run the business. They certainly know how to do that much better than we do. We're really there to help provide capital and different alternatives that they can think about for how they want to get to where they're trying to get to, call it in the next, 3, 5, 10 years. In terms of how we work with companies, it's pretty simple. We get kind of an internal financial package from a business, typically monthly, and then catching up either in person or on a phone call, with management or whomever our point contact is, maybe, every quarter or so, sometimes less frequently if a company's doing really well. Sometimes the ones that are struggling more, those are the ones you're spending more time with, of course. But because we're working in the technology space and with fast-growing companies and in the service space as well, I mean, we understand that things don't perfectly go, up and to the right, if only, right? So, it's very frequent that a company misses their plan. They've tripped something. A key deal has been delayed or is pushed to the right. And so that's very common that, we might restructure something or push something out, But I would say generally speaking, a debt provider, I mean, they want their companies to do well. We certainly want all the companies that we're working with to succeed. It's not in anyone's interest for the debt provider to try to, get really nasty and try to take control or something. Frankly, the only time when that would happen would be when the board, the founders, everybody has basically thrown in the keys and walked away. So, maybe with the exception of, I don't know, some scary loan-to-own kind of a group, very much I think it's a collaborative process. So.
And ultimately, you can be refinanced earlier. Then, and let's talk about the scenario where what you say doesn't apply, that you've made promises that you won't interfere, you won't do it. Ultimately, from my perspective, you can be refinanced. Private equity, once it's in, is very hard to exit and have to explain it, right? So
yeah, I mean, it's one thing to think about, and a reminder, just anytime you're going to raise equity, because that's permanent capital, and especially if it's material enough that you're bringing an outside group or individual onto your board, you of course want to know who you're getting in bed with. You want to do your research on other groups that they've worked with. You want to do some reference checks in terms of companies that they've worked with that have gone well, and other ones that have had some bumps in the road to understand. But yeah, that's right. It's permanent capital, so it's you can't just refinance out an investor in the way that you can with debt. And
I take it that most, if not all, funds will ask for directors' guarantees at a corporate level. Are those unlimited in nature, or are they tailor-made as well?
So, I mean, we also don't take director guarantees. I think most, at least in the US, most secured private debt or debt funds, they're secured on the assets of the business itself, but they're not taking personal guarantees from the founders or management or from the directors. Maybe occasionally you might run into that in Asia or something, but yeah, that would not be normal.
How involved would you get with the sale of a business? So say, for example, you lent me $1 million US,
yep,
and I had a lot of fun spending it, which I think I probably would. And then I'd said, oh, we'll sell in a year, Geoff, and we were getting on really well and having our lovely quarterly catch-ups, because I'd very happily come to San Francisco for that. And then I pushed the sale out, or you didn't agree with the company that we wanted to sell to. How much would you get involved in that discussion?
The short answer is that would not be our decision to make at all, and really we wouldn't feature in that discussion. That would be, you and the other owners of the board to decide. I mean, to just be really basic about it, anytime you bring on debt, I mean, the main thing is if you are just making your payments under the contractual terms, then
that's enough.
That's the biggest thing.
Okay.
But the flip side is if the business does run into enough trouble so that you're not able to make, say, a monthly interest payment and go into payment default, then that's when the provider is going to want to understand, okay, what can you do to get back on that? Is the company going to go under? Are you still healthy? What's going on? But I mean, short of that, those are all decisions that you as the owner are going to be making.
And usually as a founder, from one day to the next, you're not going to have a situation where you are facing existential threat. Our advice would be to flag issues early, whether it's a postponement of a sale process or a particular client not paying. And if you do it early enough, the lender doesn't get shocked. She or he would then work with you to find solutions. When you think about it, we are at the heart of it a people business, as you flagged. So therefore, the lender does not want to get the keys of the shop. In the absence of, say, gross negligence, even if you were to go under, essentially they've got to work with you as the founder to incentivise you to get back on your feet. One thing that's important to note is when we talk about debt, there are a variety of short-term and long-term options. At the long-term side, the term debt, which is a 1, 3, 5 year facility of its nature. I think it was the founder of PRovoke that mentioned about 365-day terms coming up. There are facilities around accounts receivable, and sometimes very specific to a particular content provider. So, Barclays, for example, has a particular product around Netflix. So if you are a content business contracting with Netflix, they will actually very quickly provide you financing. If you're a media company, you're dealing with the likes of Group M and the rest, which do have 90-day terms, that puts a lot of pressure on cash flow. And as you start new businesses, and we'll come back to that in a second, there are revenue financing options where you can actually provide a share of the revenue to come. So, in the case where we have taken money from Partners for Growth, one of our clients, in essence, part of the facility was an accounts receivable facility replacement, and the other was a term loan. Our client has the ability to take $10 million US. Now, we could not take all of that right at the get-go, but by having a facility in place which has milestones which allow our client to draw down further tranches, they can pursue growth at the pace that they want without having to stop and think about how do we fund that growth. So I think what's important for us, and it sounds like from the audience that you have that partnership with lenders already, is to think of private debt as another partner as opposed to, well, in Asia we do think of them as loan sharks and vultures, but now we've got to change our view.
Yeah, and that's normal. I would say, maybe just jumping in, capital options generally, and also on the debt side, they're more robust. There's a greater variety in the US. Debt for small companies, especially companies that are burning money outside of the US, whether it's in Asia or Latin America or MENA, that's really hasn't existed that much. And so I think that's part of the reason why, too, there's a little bit of education outside the States that we do, at least at PFG, in terms of reminding folks that it's another option, a capital option you can think about, as opposed to as a last resort. If you can't raise money anywhere else, then you find some kind of debt group, and if that's kind of where you found yourselves, that group is probably, they might not be the best one to go forward with.
Yeah. I think Paul said, he was there, he's gone now. In his introduction, he was saying that, firms like ours are the most exciting, which we would all agree that they are, and we take the most chances, and we do lots of exciting and interesting things, trying, I guess, to establish new businesses in new markets, or trying out things that maybe a larger firm would take longer to be able to put into action. I think that's very exciting. We've been able to finance that out of our cash flow, right? Out of our profit, happy days. But also, clients are taking longer to pay, and I'm sure everybody in the audience will nod with me. Can you nod with me if they are? Thank you. Because I know we're before drinks. I know that we are between you and your alcoholic beverage. Thank you, Julian. But it is getting harder, and it is and we've heard so many different excuses. I'm sure we could spend hours talking about, and probably have a little board with the best ones. But every company that we work with really is taking longer to pay us, which puts pressure on us. Now, what I find is that if I was to go to, let's just say HSBC, and say, hello, HSBC, I've been banking with you for 30 years. The amount of time I've lived in Asia, please would you give me a loan? I would think they would say no. So I think having this as a different, maybe, arm that I could actually reach out to is very interesting, and one that I personally haven't really thought of before. So I'm grateful to actually learn a lot more about it.
And you have a good CFO, and I've known him from his time at We Communications as well. I wonder, for the dividends that you've used, they have an opportunity cost. You could have bought another property in Hong Kong.
My husband's not always very happy about it.
But have you put a value of an internal cost of capital where every time you've used your equity, you've said, well, that's 25% return that I've foregone? Have you done that exercise, or whatever percentage it is?
No, I haven't. I mean, what we've done is every time it goes back, and my husband's name is Andrew Stevens, so we say we go to the bank of Andrew Stevens to get money. Even though it's my money too, of course. But dipping into that, we haven't. I mean, obviously we've ring-fenced how much of those dividends have gone back in, because like the panel before, we have equity plans. We have two. We have a junior partnership, and then we have senior partnership as well. And I'm a great believer in giving equity to our senior people, because they're working so hard and they deserve to benefit from any growth. So that's all sort of ring fence, how much has gone back into the business, but I haven't thought about it like that with what, maybe I could have made more money if I'd been speculating on the stock market or putting it all on red at the casino. Who knows?
Who knows?
We're close to Macau.
Yeah. We have a number more questions, but I thought we've talked a lot. Maybe I'll just pause and invite you to make comments or questions to anyone on the panel. So.
There's 4 questions.
Great.
I'm so grateful, thank you. Hopefully none of them are to me. I don't
Hi.
think they will be.
I chaired the panel beforehand, but I moonlight as an incentive comp lawyer, but I'm really an M&A lawyer. That's mainly what I do. So part of the attracting and retaining talent is to position companies for an ultimate exit. So, Geoff, I'm interested about what you do, and so I have 2 questions really. One is, will PFG also just provide working capital lines for companies, so that if they just, because I am a big believer when I'm prepping a company for sale, that most owners of PR firms, they're very debt hesitant. They don't want any debt on their businesses. And I feel the other way. I feel like, I think you should have an established credit line available, because it enables you to act on opportunities that you might not otherwise be able to afford strictly from payment of free cash flow. And I have a number of clients that have missed out on opportunities to be able to bring in a handful of talent or do a limited acqui-hire. So my question number 1 is, do you provide just straight kind of working capital lines? And then my second question is it straight debt? Do you ever have like a blend of a debt with an equity kicker or warrants or things like that?
Yep. Yeah, good question. So first, yes, we provide working capital lines of credit, term debt, different kinds of structures, and that would be just a great point to kind of think about the use of proceeds that a business is looking for. But it could be anything for general working capital purposes. It could be general corporate purposes. It could be term debt for you're making select investments in people, R&D, sales and marketing. It could be a line of credit for M&A, for acquisitions, for the cash piece that you're thinking about. So it could be kind of a whole host of reasons, and everything from, hey, we're tight in cash, maybe it's a seasonal business, or hey, we have really chunky contracts with our customers, so we're trying to manage that. So yeah, we can provide lines of credit for that, and then you can borrow up and down or not as a business needs, or it could be term debt that is funded up front, or maybe it's tranched over time based on need. So kind of, yeah, it could be anything. And then your second question, at least on the PFG end, we're kind of a hybrid structure. So while we're a private debt fund, it's debt that is secured on the assets of the business, even though there's not a ton of assets there, but we're secured on the business. There's current pay interest on the debt, which tends to be in the low double digits, call it 11 to 13% or so. And then there's an equity warrant or a kicker. And so it's kind of a blended return. But yeah, again, and kind of the way that we think about it is, hey, if a business is raising, $5 million of equity, they're going to sell this much. And if they're raising $5 million of debt, but giving an equity warrant, that maybe you're saving, 70, 80, 90% of the dilution versus equity. Or if you're really fortunate and running your business like Emma really well and growing 3 or 4x and cash flowing, then you can do anything you want or nothing. So that's the strongest position to be in, of course.
And there's horses for courses. So some of our clients have said, we don't want to have any warrant structure. Well, then you'll have slightly higher interest costs, and it would be, for example, PFG. We could not tap PFGs. Some funds are flexible, so I think it's a matter of just having conversations. But to your valid point about debt, we're also, the bulk of our revenue comes from M&A, frankly. The reason why we do partnerships and debt is we want to be close to people like Emma for a longer period of time. If I wait till she decides that I'm ready to sell, she will go to, I know who she might go to, but if we are with her along the way, we've learnt the values of the company, because M&A is, in our sector, is not just about consideration, it's about the right cultural fit for the founders and also the staff that are going into the new environment. So that's why we've made a conscious decision. I'm Greek by background, so even though we're only 11 million people in Greece itself, there's more Greeks outside of Greece. We are the largest owners of ships in the entire world. I think China just pipped us in the last few months. And that's been driven by debt, prudent use of debt. But to your fundamental point, if you take debt as a strategic option, you know that deals are done on a debt-free basis. So you can either pay off the remaining debt from the consideration if you cannot pay it back before the deal is done and clear the books. You can actually say, okay, I think you are worth $100 million, by the way, but let's say you owe 10, that of that 100 million, 10 will go to pay off the debt. So it becomes just an option. Second question, yes.
Are you going to swear if you're in that line?
I'm not going to swear and I'm not going to sneeze, so I'm okay. Hi, I'm Jo Carr. I'm one of the co-founders at Hope and Glory. That was very useful to talk about both private equity and also debt. But I think, Emma, I've got a question for you, which is, I think it's probably the question a lot of people have here. It's, why did you sell to Engine and then buy it back?
Oh.
Are we allowed to talk about that? Because that, I think, anybody who's got their own age...
Arun is laughing. It's a very good question, isn't it?
Are you going to answer it?
Of course. Of course, I will. Well, when I sold... So I started to build my business in around 2004, and then I sold it in about 2014, but I sold 51%. And I bought it back in November 2019, so just before COVID hit, so amazing timing, right? Just incredible timing. But I bought it back because, we all know Engine was going to be sold and they were looking at selling their businesses. I think they had 18 different businesses and I was the only part of that they didn't own 100%. So I just said, why don't I buy it back rather than me sell to you? Because I wanted to continue to build and grow.